Tradingview recently introduced a new chart type, the high-low chart, and for price action traders, this could be of great help. Today I'll show you how to read price action using the high-low charts, and you'll also learn how to easily find trends and trade with the current momentum. You know the drill. Like, subscribe, and stick around for the full video. The high-low chart is located in the chart type selection menu. Bars are built based on the value of the maximum and minimum prices for a given time frame. The price values for which the chart was built are displayed on each bar, below and above the bar. This type of chart basically removes the open and close price, and instead you see the range in which the value change on your time frame. If you want to customize it, in the chart settings, you can change the color of the bars and the text. I personally don't have a problem with the fact that I don't see the red and the green color of the candles. By having the same color on up and down candles, you'll actually trade in a neutral, unbiased state of mind. This chart looks weird at first, because you don't see the open and the close. You are only seeing a range. But from a price action perspective, if you are a trader who is analyzing highs and lows in price, this is very helpful. Most traders are looking at major market swings when they are analyzing highs and lows and determine trends. But you can also analyze highs and lows of individual candlesticks. With the high-low chart, reading price action of individual candlesticks is super easy. When the high and the low of the recent candlestick is higher than the high and low of the previous candlestick, market is in a bullish momentum and buyers are controlling the market. There is buying pressure. When the low and the high of the recent candlestick is lower than the low and the high of the previous candlestick, market is in a bearish momentum and sellers are controlling the market. You see just how easy it is to read price action, bar by bar. Now, using the high-low chart presents an opportunity to simplify candlestick trading. If you are that type of trader that memorized dozens of candlestick formations, you're in luck, because you don't have to overcomplicate things. With this type of chart, there are only 4 candlestick formations. First candlestick formation is the bullish candle. A bullish candle has a higher high and a higher low compared to the previous bar. Second formation is the bearish candle. Bearish candlesticks have a lower high and a lower low, again, compared to the previous bar. Third type is the inside candlestick, which has a lower high and a higher low relative to the previous bar. This bar is contained within the range of the previous candlestick, even if the high or the low are equal to the previous candlestick, it's still an inside bar. And the last formation is the engulfing candlestick, which has higher high and lower low relative to the previous bar. And even if the high or the low are equal to that of the previous bar, it's still an engulfing bar. So this is the foundation of your price action analysis: bullish and bearish candlesticks, inside candlesticks, and engulfing candles. It's time to train your eyes to easily spot each formation on a high-low chart. Just open any chart and start reading price action. We have both highs and lows that are lower than the previous bar. So this is a bearish candlestick, another bearish candlestick, and another one, another bearish candle. And here's the first inside bar with a lower high and a higher low compared to the previous bearish candle. Next is a bearish candle, another bearish candlestick, and another one, and another bearish candlestick. Again, a bearish candlestick. Bearish candle once again. Okay, we have our first engulfing candle with a higher high and a lower low compared to the previous bar. Another bearish candlestick. Next is a bullish candlestick with a higher high and a higher low compared to the previous bar. Another bullish bar. And now trend seems to change to the upside. Bullish candlestick again. Another bullish candle. Next is an engulfing candle. And here's a bearish candlestick. You see just how easy it is to read price action. I'll say it again, you don't need to memorize other candlestick combinations. So to get used to the high-low charts, the first thing is to start reading candlesticks until it becomes very easy to determine which type is. Now, you might ask, how is it useful to trade? It's simple. Once you know to recognize these candlesticks, you'll then determine the state of the current trend. To find the current trend, you follow 6 easy rules. If you have consecutive bullish bars, you are in a minor uptrend. Consecutive bearish bars indicate a minor downtrend. A bullish candle starts an upswing and confirms the end of a downswing. A bearish candle starts a downswing and confirms the end of an upswing. Inside candlesticks are neutral bars. They don't affect the direction of the current swing because they don't break the previous high and low. So an inside bar after a bullish or a bearish candlestick don't change the current trend. Engulfing candlesticks introduce uncertainty into the market structure because they break both the previous high and low, but will give the benefit of the doubt to the current trend. So engulfing candlesticks in an upswing continue the upswing, and engulfing candlesticks in a downswing continue the downswing. Now let's look at the previous example and let's mark the main swings based on the bars that changed the direction of the market swings. These bars are inside candlesticks and engulfing candlesticks, and they don't affect the direction of the market swings. Let's change markets and find the market swings based on this system. You simply look for bullish candles to start an upswing and to confirm the end of a downswing, and for bearish candles to start a downswing and to confirm the end of an upswing. And you include the inside candlesticks and engulfing candlesticks in the respective swings. First we have a downswing with many consecutive bearish candles. Then an upswing. This is the candle which interrupts the previous down leg. And another downswing. This is the candle which ends the upswing. Then market forms an upswing. And another downswing. Upswing once again. Then I see a choppy period with a small downswing, a small upswing, and another downswing. And finally another upswing. This analysis might seem very simple and unimportant, but if you understand how the swings are marked and you see the swings clearly, you'll identify the current direction of the market with ease at any point in time. I found that high-low charts are great to trade support and resistance, and are also a good filter to eliminate false breakouts when price moves beyond the previously established price range, but then retreats back to within the range. As you probably know, one of the classic rules of support and resistance is that support, once violated, becomes resistance. And conversely, resistance once violated becomes support. With high-low charts and the previous swing recognition technique, you can find decent trades around major levels in the market. So on this pound-dollar hourly time frame, we see an uptrend, with price trading around this resistance level. We have a candle breaking the previous high and a quick retracement below the level. After small consolidation, we have a valid breakout. So a decent signal would be at the retest of the previous level when the downswing is ended with a bullish candlestick. Here's the signal. I like to enter when the high of the bullish candle is broken, but you can also enter immediately after you see the candle. Stop goes below the most recent swing and will be conservative and will set a risk to reward ratio of 2. You see how using this type of chart helped us to avoid the first fakeout and allowed us to enter in the direction of the main trend when a new upswing was forming. Another great way is to trade liquidity clearouts in the direction of the main trend. If you watched my previous smart money manipulation video, you know I like to join the markets after a false breakout. Markets hunt for stop orders and activity beyond significant price levels. If this breakout occurs and fails, there will be many trapped traders, which can add momentum to the opposite direction from that level. The best trades of this type occur in the direction of the main trend. In this example, we have a clear downtrend, with price currently in consolidation. For a short entry, the market trades above this resistance area and immediately reverses on the following bars and closes back under the resistance. There's no real continuation beyond the level. And when price forms a bearish candlestick, which ends the previous upswing, we can take a short trade after this liquidity clearout in the direction of the main trend. Stop loss goes above the previous swing high and will target this next swing low in the price structure. Here's another example. We have a clear support in an obvious uptrend, with the price being unable to continue lower. We then have a small breach below support, but price immediately closed back above the support level. Once the movement was confirmed by a bullish candle, the wiser trade would be a long trade instead of chasing the failed breakout. Stop loss is placed below the previous swing low and will target this next swing high in the price structure. In some way, high-low charts eliminate some market noise. You don't see the wicks, the red or the green candles. I can see the market swings and the support and resistance levels very easy using high-low candles. You see, many traders follow market swings in a wrong manner and find them useful only in hindsight. They are unable to apply the concept of market swings in real time. With this chart, and following some basic price action rules, you will know exactly the current price wave you are in, and with a solid understanding of support and resistance, you will find good areas to trade from. course, there are lots of other methods to trade the high-low charts, involving volume and even with indicators. Divergences in particular work very well in combination with these candles. So if you want a follow-up video about the high-low candles, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.